It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, smartest guy in the room, Mr. Michael Becker.
Hey, Paul.
Michael, as you know, has owned over 7,000 apartment units, 33 buildings, 33 apartment communities.
Yeah.
Unbelievable. I remember when you had 14 single-family homes.
Yeah, a long time ago.
When you were with a banker with a large national bank and he led his region in commercial real estate lending. So Michael, who's been a loaner of money, now is the owner of a lot of apartment buildings. So we turn to Michael to get a lot of good questions answered. So Michael, what's going on in the SPI world these days?
Oh, just doing our thing, trying to get a couple deals put together. We're about to come out with a few deals, so it's exciting. We're going to kind of break the logjam finally after having many months of a dry spell. So we're excited about buying a couple deals. One's in the Dallas area, one's in the Austin area. So just kind of putting the finishing touches up as we record this, and hopefully we'll be proud owners another 500-plus units come May.
That's good for you. Good for you. So here's the question for Ask Mike Mondays. Mike, love the podcast. What rates of return can I expect for a multifamily investment, and what real risks are there?
That's certainly a topic we get asked all the time, is kind of what if I give you X amount of money, when and how much do I get back, basically. So these days, it's one of the things of kind of the conversation we're having here lately is, everything's a little tighter than what it was a few years ago. So kind of what the rate of return expectations have certainly come down. If you go back when I bought our first several deals, 6 or so years ago, we were projecting, IRRs north of 20 and, double-digit cash-on-cash yields pretty much out of the gate with a bunch of upside. And when those properties ultimately sold, we far exceeded those return projections because, part of that is I think we did a good job of buying deals right, managing them effectively, and doing cost-effective smart renovations. And then part of that, the market was absolutely on fire, and you could buy something that had 20% upside in income and buy it at north of 8 cap and sell it at a 6 cap, and rental rates grew 8% a year. So I look like a genius along the way.
You are a genius.
So, some of the returns certainly were us, and then some of it was the market. But, the reality today is the cap rate spread over your interest rate is not quite as wide as what it used to be. So your returns are getting squeezed, and the leverage is getting squeezed. So basically the kind of general sense is everything's lower and longer, basically meaning that was north of 20, 6, 7 years ago. I mean, most of these deals are kind of ranging between 13 to 15, Paul, that I've been seeing, kind of 13 to 15 total IRR, or average annualized return. So there's really kind of two components to that. There's the yield, or the cash flow you get along the way, and then there's a future capital gain. So when you sell it, there's kind of a pot of gold at the end of the rainbow, per se. So what we've always tried to strive to hit was double-digit cash-on-cash yields, and that's becoming much harder to do today. So what I kind of say is last year's 10 is this year's 9. So most of these deals are kind of stabilizing around that 9% range, kind of plus minus. When I say stabilizing for us, that's kind of year 3, Paul. So, year 1, you're talking like 5 to 6, kind of cash on cash. Year 2, kind of 6 to 7. And then by year 3, we're hoping to try to hit 9, maybe a little bit more. Sometimes it's a little bit less, kind of going forward on your stabilized yield. The other component of it is the capital gain at the end. So most of the deals we project, and most people I know, you tend to project, either a 5 or 7 or 10-year interval. We always tend to underwrite to a 5-year hold. So we're targeting equity multiples somewhere around like that, 175 range. So what that means is if you give me $1 between the cash flow you get along the way and a capital gain at the end, we try to turn $1 into $1.75. So if you average all that together over a 5-year period, 14%, 15%, something like that. And that's pretty common what I see, not only with myself and the deals we put together, but a lot of the other competitors or other people that sponsor deals are somewhere in that general range. If you think about it, if you're buying, some lower quality stuff in tougher locations, the risk profile, that's a little bit higher. So I would hope that you would expect to get a little higher IRR, Paul, than something that's a little bit safer. Or if you're doing something like in super urban core, if you're in like Rodeo Drive in Beverly Hills, you expect to maybe get a little bit lower yield on it because the perceived risk on that's a little bit safer. So there's the concept of total returns, the concept of risk adjusted return. So make sure when you're comparing this IRR, this multiple on this deal to the next one, you also in your mind thinking through like level of the risk that is inherent with whatever sponsor you're investing with. as well as the characteristics of the deal. Is it a deep value add? Is it more of a yield play? And then the specific location. Is this in a high quality area near a bunch of retail and better school districts, or is this in the middle of the hood? And those, all returns aren't created equal. So even if they're the same gross numbers, but you take in different levels of risk, you should, be compensated for additional risk in there. And that's kind of my general rambling thoughts there, Paul.
No, I can believe that. I've had investors put, let's say, a 10%, 9% rate of return, but that area that they want to invest your money in is not that good. So, with a risk-adjusted return, right now, cap rates on a B, C property, Mike, tell us.
A B cap on a deal with some upside. It's, 5.25, maybe lower if there's a bunch of upside. Being in the fours certainly is not uncommon if there's a bunch of upside in a C deal. Maybe at 25 to 50 basis points on top of a B deal. So, maybe 5.25, 5.5. And if it's got a lot of upside, I've seen some C deals also have a 4 in front of it. And then you go to like the A deals, and the A deals are all in the high 4s, maybe even upwards of 5, depending on location in the Dallas-Fort Worth metropolitan area. So the spread really isn't as wide as what it used to be. So if you're overpaying, or if you're paying similar cap rates for a C deal, you better have a pretty good reason to pay the same cap rate for something that's 20 or 30 years older than something that's a little bit newer. Not saying you shouldn't do it, but you should understand why you're doing it, and there better be a compelling reason that there's X amount of growth in the rental rates, or there's some straightforward value add you can implement.
Yeah, just on like common knowledge type of stuff, you would think a C property is going to be in an older area, more demographically diverse area, and that you're paying the same cap rate as a B deal that's probably fairly newer, probably built in 20 years ago, 25 years ago or so, versus built in the 60s or 70s or so, but you're paying kind of the same cap rate. But only people see is the rate of return on the pro forma. So, make sure that when you look a little bit deeper into these pro formas, don't get fooled to go down the rabbit hole that an 8 or 9% rate of return on a C deal that's a great deal. Sometimes you're going to be challenged with that 8 or 9%, maybe only for 1 or 2 years, that they can't keep that rate of return going because they have to make some of these large capital improvements to the property, which they fail to put that onto the pro forma, versus buying a little higher quality B deal with higher technology, maybe in a better area. But that may be 8 or 9%. I'd rather have the 8 or 9% that's going to be longer than shorter in a better area, higher quality area, better schools, better construction, better technology.
Yeah, I think the point is nothing's in a vacuum. So there's judgments you have to make when you're looking at a deal, and the business is really, really simple. It's not always easy, but it's really simple. So just apply some basic level common sense and take a critical eye. When I'm looking at this deal with these types of returns compared to another deal, there's the same return. One of them's a little bit out of whack, generally speaking, on a risk-adjusted basis.
Yeah, because I can't tell you how many times I said, don't invest in that area, and the person's done very well. They put money into that area. They were in the property for a year or two, and they made a ton of money. And prior to them doing it, I told them, don't do it. But
yeah, just because you got a good result doesn't mean you made the right decision.
That's right. I would say you're damn lucky, because history's going to prove that's not a wise decision. That's a risky decision. You were lucky one period of time. Don't double down to that same area, and hopefully it's going to have the same result.
That's right. You play roulette long enough, eventually you bust out.
That's absolutely right. 2 things. If you find value in our podcast, make sure you go back into iTunes and give us a 5-star rating. We would very much appreciate that. And then also, too, don't forget the 19-page white paper report on Multifamily 101, kind of the 2019 updated version that Michael, James, and myself updated about how to really finance these apartments. And that's what we do. Old Capital, we did over $1 billion in apartment lending in 2018.
Sounds like a lot, Paul. Is that a lot?
That's a lot. That's definitely a lot. So if somebody wanted to get more information about what SPI does, Michael, what's the best way for them to get a hold of you?
Yeah, simply the easiest way to find out more information about what we do is go to my company's website, which is www.spiadvisory.com. That's SPI like spy advisory.com. There's a contact us form. You fill that out. I'm always happy to have a 10 to 15-minute telephone call with listeners off the podcast and talk a little bit more about what we do and how you could potentially work with us.
That'd be great. Fantastic. Michael, thanks for being on the podcast. I appreciate it. Again, Paul Peebles, have a great day.